Three completely different stories, one brutal outcome. A real estate business wrapped in the language of technology, sold as innovation, where investors poured in billions. The hype exploded, and the founder quietly walked away with $2.4 billion, while the company collapsed into bankruptcy. A so-called hydrogen and EV giant with no real technology, no functioning product, yet a valuation north of $30 billion, worth more than legacy automotive brands that actually built cars before it vanished almost overnight. And then an AI robotics company that did the opposite. Real technology, real products, real love from consumers. They were building advanced AI and robotics as early as 2013 and still ended up bankrupt. In this episode, we are not chasing hype. We are breaking down what actually happened and why money, technology, and vision alone don't save a company.
The billion-dollar lie. When millions don't guarantee success. Inside startup failures that raised big, but crashed anyway. When a company raises tens or even hundreds of millions, it feels like destiny. But funding is not a shield, it's a microscope. We will pull the cover off some of the big failures and show how huge raises can hide tiny cracks that became catastrophic. Tell me in the comment section below if you have a specific company that wants to get deeper inside of their failure. If you're building a startup, remember this is your wake-up call. From short-sighted moves to pure deception, raising millions of dollars is the Silicon Valley dream. It's treated as a victory lap, a validation of genius. But what if that funding isn't a shield, but a spotlight? A bright, unforgiving light that magnifies every tiny crack in a business until it shatters. Welcome to Fundalog. Today we are investigating the graveyard of well-funded startups. We are not just telling stories of failure. We are performing autopsy. We will uncover the specific repeatable reasons why investor gold turned to corporate ash in cases like WeWork, and expose how billion-dollar dreams crash and burn. Funding attracts headlines, but it doesn't guarantee product market fit, healthy unit economics, or mature governance. The companies we will dissect got capital, attention, and scale, and still collapsed or nearly did. These stories expose recurring patterns, mismatched cost structures, over-reliance on one-time revenue, misleading signals, governance gaps, and an obsession with growth that outweighed fundamentals. When long leases meet short-term customers. Sell membership, rent forever, what could go wrong? The promise was simple: revolutionize office space by creating a community-driven, flexible workspace for the modern age. But beneath the free beer and glass walls was a business model that was centuries old and dangerously fragile. WeWork scaled by signing long, multi-year commercial leases and subleasing flexible desks and offices to members on short-term arrangement. That asset-liability mismatch, long fixed rent obligations versus short, sometimes month-to-month revenue, made the business fragile. As the company rapidly expanded, occupancy and operating costs needed to be near perfect to cover those fixed costs. The core deception. A real estate company in tech clothing. WeWork wasn't a tech disruptor. It was a subletting company with a branding, but its fundamental flaw was an asset-liability mismatch. WeWork would sign long-term leases, 10 to 15 years, with landlords, creating a massive fixed long-term liability. Then it would sublease that space to members on short-term, month-to-month agreement. This is like taking out a 30-year fixed mortgage on a house but only renting it one night at a time on Airbnb. When demand dips, you're still on the hook for the mortgage. Adam was a former baby clothes salesman with a huge ambition. Miguel was an architect who grew up in a commune. Together, they shared one belief: work doesn't have to be miserable, and empty office spaces is wasted potential. So, they launched a small experiment called Green Desk in Brooklyn. Eco-friendly co-working spaces, bamboo furniture, low-cost rent. It took off immediately. The landlords loved the idea so much, they bought it from them. Adam and Miguel took the payout. And instead of celebrating, they asked, why not build this for the entire world? It looks like it will work. So why don't we create a big lie and steal investors' money? In 2010, inside a rundown building in Soho, they launched WeWork. They sold not just office space, they sold community, energy, and identity, wrapped in a marketing lies for those who believe in that. Yes. Freelancers wanted it. Startup wanted it. Even big companies wanted it. And investors, they went crazy. Valuation skyrocketed. $1 billion, $10 billion, then almost hit $47 billion. WeWork wasn't a startup. It became a symbol of the new work culture. What happened? Governance problems and founder-related conflicts added fuel to the fire. Details uncovered in IPO filings and reporting revealed odd related party deals and management style that raised investor questions. The 2019 public listing attempt collapsed. Leadership changed, and later restructuring plans and massive capital interventions followed. Eventually, the company faced bankruptcy-level restructuring and dramatic valuation collapse. See timeline: IPO filing problems 2019. Critical turning point. Aggressive lease expansion without conservative stress test for demand drops. S1 IPO disclosures that highlighted governance and conflict of interest issue, triggering investor skepticism. When market sentiment shifted, the leverage in lease forced abrupt retrenchment, renegotiations, closures, and huge value write-down. The House of Cards, governance, and the SoftBank conspiracy. The 2019 IPO attempt was the moment the curtain was pulled back. The S1 filing revealed staggering governance failures. Founder entrenchment. Adam Newman had shares with 10 times the voting power. Related party transactions. He personally owned properties that he then leased back to WeWork. The therapy incident. He trademarked the word "we" and sold it to his own company for $5.9 million. Can't you see it was planned to steal the investors' money? But the story goes deeper than quirky founder. The narrative of stealing SoftBank's funds centers on the $1.1 billion personal line of credit Newman secured against his own shares and the nearly $1.7 billion he cashed out during SoftBank's investments. While it's not illegal, it revealed a misalignment. The company was burning cash, yet the founder was securing personal liquidity on a scale that suggested a lack of faith in his own creation. Why did investors believe it? They were not buying office space. They were buying a story. That's the power of marketing and storytelling. A story about elevating the world's consciousness, about community, and about a metric called community-adjusted EBITDA. A made-up metric I can't even pronounce it. Conveniently removed massive costs like marketing and brand. They saw a narrative of limitless growth in the space as a service market, blinded by the charisma of a founder who sold a vision, not a viable business. The idea itself wasn't new or groundbreaking. What impressed investors was how they scaled it with speed, style, and branding power enough to turn simple co-working concept into a global phenomenon. WeWork proved that the real innovation wasn't in flexible offices, but in flexible ethics.
Tell me about it.
Who needs a profitable business model when you have a charismatic founder and a venture capital firm willing to fund the fantasy? The practical takeaway for founders: avoiding the scam that the founder was actually operating. If you're locking into long-term fixed cost model worst-case demand scenario, know your break-even occupancy and stress test it with a 20 to 40% downturn, and be brutally transparent in governance. Investors will dig. Plus, don't steal your investors' money if you want to create a real business. The WeWork saga proved that if your true ambition is to steal investors' money, all you really need is a designer suit, a fake changing the world ideology, and a bloodstream full of charismatic deception. Who needs profit when you can sell community wrapped in glass walls and free coffee as a new tech disruptor? Nikola. The big lie. A technology company with no technology. Big presentations don't make production lines. If WeWork was a bad business model disguised as tech, Nikola was something more straightforward, a mirage. It promised to revolutionize trucking with hydrogen fuel cells and electric semis, but its most impressive engineering feat was in the realm of mud. Picture the EV world in the early 2010. Tesla was just starting to shake the industry. Electric trucks were still fantasy, and the market looked wide open for the next big disruptor. Enter Trevor Milton, a charismatic dream seller with a big vision. Build the future of zero-emission trucking. In 2014, Trevor founded Nikola Motor Company in Salt Lake City. His pitch was bold and loud. Hydrogen-powered semi-trucks that could be diesel on cost, range, and performance. To investors, the idea sounded like the next Tesla-sized revolution, but for Fry, and like any great startup story, the timing was perfect. Regulations were tightening, logistics companies wanted cleaner fleet, and the EV wave was rising fast. Nikola unveiled early concept with the futuristic designs, massive projected ranges, and promised to build both the trucks and an entire nationwide hydrogen fueling network. Investors loved it. Partners lined up. Big companies kicked the tires. Then came the moment that changed everything. In 2020, Nikola went public through a SPAC deal, and the valuation exploded past $30 billion, briefly making Trevor Milton a billionaire on paper. For a company with no trucks in massive production, that was historic. What happened? Nikola promised hydrogen and electric commercial trucks that would disrupt a capital-intensive industry. But high-impact allegations followed. A short report accused the company of misrepresenting prototypes and exaggerating readiness. The founder resigned amid controversy. Regulatory and investor scrutiny intensified. Legal entanglements and audits chipped away at credibility. Critical turning points. High-profile demos and product marketing that outpaced verifiable engineering and production readiness. A short seller report that questions public claims, triggering a loss of trust and capital access. As production challenges and costs materialized, investors repriced risk. Aggressive fundraising became harder. The cornerstone of Nikola's deception was its 2018 promotional video of the Nikola One truck cruising down a highway. The company claimed it was a fully functioning vehicle. In reality, as detailed in the Hindenburg research report and later confirmed by federal prosecutors, the truck was not driving under its own power. It had been towed to the top of a hill and simply rolled down. The company had fitted a fully functional gravity-powered vehicle with an unfunctional hydrogen fuel cell. So the question, how they convinced the giants? Nikola's playbook was masterful. They secured the landmark partnership with General Motors in 2020, sending its stock soaring. How? By presenting technology and vast order book. They claimed to have over 14,000 pre-orders worth over $10 billion. However, many of these were from companies that had no obligation to actually buy trucks. It was a house of cards built on non-binding letters of intent, making the demand look far more real than it was. The collapse was swift once the lies were exposed. The founder, Trevor Milton, was indicted and convicted on multiple counts of fraud. The SEC settlement and the OJ case painted a picture of a company that, at its inception, was more focused on enriching its founder through stock manipulation than on the grueling, capital-intensive work of building a truck. The company faced the brutal reality of hardware scale. Production, supply chains, safety standards, and certification are expensive and slow. Always remember, hardware is unforgiving. When your financial story depends on a future manufacturing scale and cost declines, any gap between promise and demonstrable capability is existential. Capital rise up quickly when credibility erodes. Let's not mention, if you have an idea of creating technology still not existing, capital will not create it for you. You will need real expertise and patents. So what can we learn? In hardware, show production milestone, not just glossy marketing. Bake conservative timelines and contingency capital into your plans. And always remember, Nikola's biggest innovation was in gravitational propulsion, demonstrating how easily a company can roll downhill when built on a foundation of pure hype. Anki, the tragedy of great product. Why a great product isn't enough. Cute robots sell and store, but margins and service run the show. Now let's talk about a company that failed for the opposite reason. Anki didn't fail because of deception. It failed despite having a fantastic beloved product. This is the tragedy of getting the product right, but the business model wrong. Anki's Cosmo and Vector robots were engineering marvels. They used advanced AI and computer vision to be genuinely engaging and emotive. People loved it. The technology was so real. So what went wrong? In the early 2010s, Silicon Valley was obsessed with one thing, right? Bringing artificial intelligence into everyday life. And one small startup believed the future of AI wouldn't live in labs. It would live on your desk. Anki was founded in 2010 by three Carnegie Mellon robotic graduates. Their idea was simple but ambitious. Combine robotics, AI, and entertainment into consumer product anyone could use. The first big break came fast. In 2013, Anki debuted at WWDC, a massive stamp of credibility. Apple didn't just feature them, they backed them. Suddenly, Anki wasn't a student project. It was a Silicon Valley doll. Anki launched products like Anki Drive and later Cosmo, a small robot with personality, emotion, and facial recognition. Cosmo wasn't just a toy. It was marketed as a glimpse into the future of human-AI interaction. The press loved it. Customers loved it, and investors poured in more than $180 million. The unit economics trap. Anki was a hardware company. Its revenue came almost entirely from one-time product sales. Each robot sold had to cover not only its own manufacturing cost, but also the massive ongoing research and development, cloud infrastructure for AI features, and customer support. This is the brutal model. When you sell a physical object, your revenue is a spike, but your costs are constant. There is no recurring revenue stream to smooth things out. If a new product launch underperforms or if manufacturing costs creep up, you have no financial cushion. According to post-mortem reports, Anki was burning over $1 million a month trying to scale its operations and support its products, all while relying on the next big hit to keep the lights on. When they failed to secure a final round of funding because investors looked past the cute robots and saw the precarious financials, the company simply ran out of cash. It's a stark lesson. A great product is not a business. A business is a sustainable economic engine. looking at the company and summarizing what really happened step by step. Anki's robot toys, Cosmo Victor, charmed consumers and sold well. The company raised large funding rounds and built great tech, a classic smart product story. But the business model leaned heavily on one-time product sales rather than recurring revenue. Manufacturing complexity, warranty costs, cloud dependencies, and the cost of supporting physical device created a high fixed and variable spend profile. When expected future funding didn't materialize and margins stayed thin, the company couldn't sustain operations and ultimately shut down. Its assets were later bought by a third party. So what's the turning point? Dependence on one-off hardware sales with insufficient recurring revenue, manufacturing and after-sales costs that eroded margins faster than scale could fix them, failure to secure follow-on funding at the critical late-stage inflection point. Always remember, hardware plus consumer retail requires relentless margin management and predictable after-sales economy. Without recurring revenue or a high margin, even a loved product can lead to bankruptcy. The takeaways: design recurring value into your product early, subscription, consumables, enterprise services. Model the full life cycle cost, support, return, cloud hosting, and be conservative about gross margin assumptions. Anki proves that strong technology without a scalable revenue model is not a business, it's a liability. The company built advanced AI and robotics, but relied on consumer hardware sales to fund long-term R&D, creating a structural imbalance between costs and revenue. High production expenses, thin margins, and one-off purchase couldn't sustain continuous innovation. Without recurring revenue, predictable cash flow, or a clear expansion path, growth became fragile instead of scalable. The takeaway is simple: understanding how money is generated, retained, and expanded is just as critical as building the product itself, because scale is financial before it's technological. So it turns out the real business model is often just selling a compelling lie to investors who are too eager to buy it. Forget the product, skip the due diligence, just master the performance of leadership, and the following will follow. The system doesn't just reward deception, it practically begs for it. What these stories really show is this: building a company isn't just one thing, it's about mastering many things at the same time. Product, the real problem; the solution, marketing, technology, funding, the business model, and the most important, the future you are building toward. The startups that survive aren't always the smartest or the most funded. They are the ones stubborn enough to understand their market, adapt fast, and navigate reality instead of fighting it. Every successful company learned how to move through uncertainty, not around it. This is Shadi from Funderlord. In the next episode, we will break down more companies and zoom out to understand why they failed despite massive funding and hype. If you found this useful, like it, share it with your co-founders or anyone thinking of starting a business. Subscribe for more and let me know in the comment section below which company you want me to cover next time.